Hello, everyone, and welcome back to the Financing Freedom channel. Thank you for joining us as we dive into video number 2 of our Options 101 series. Today, we're going to discuss call options, buying, selling, maybe why we would want to do this, and what are the benefits to one versus the other. The most boring part, of course, is the definition. What are call options? Well, call options give the holder the right to buy an asset at a specified price before the option expires. Well, what does that really mean? Well, when you buy a call option, you own the right to purchase 100 shares of whatever stock you choose at a price you choose within a certain time frame, which is your expiration date. How do we choose that price? Well, it's called a strike price. This strike price is an agreed upon price of the shares that you will either purchase or sell. Traditionally, stock prices are in round numbers. And so if we look here, this is Fidelity, and this shows the strike price. Now, on expiration dates, usually 45 days ish or more out, you're going to have round strike prices. So this will be $11, $12, $13, etc. And then for weekly expirations, you might see some fractional prices. You might see $11, $11.50, $12, $12.50, etc. It just depends on the stock. They might not be that round 50-cent mark. It might be 30 cents or 80 cents or 82 cents sometimes you see. It just depends on the specific stock and kind of the volatility to it and how much it may or may not move during that specified time period. And so inside of a month or 45 days, you usually see these fractional zones. And this just gives you more options in regards to pricing because it's probably not going to move an entire dollar in the shorter time frame or whatever that round amount is. For some stocks, it might be $5 or $10, etc. Kind of what's the functionality of this call option? Well, call options provide the buyer the ability to call away the shares from the holder or take ownership of them. So that's giving you that right to make those shares yours. What we're looking at here is a trade ticket from Charles Schwab. And why would we buy a call option? Well, American Airlines here is trading at $13.83. And we think it's going to go, let's just say, to $15. You can buy a call option, and that gives you control over 100 shares. And if you look here, you could purchase it for $74, $75, $76, whichever price sounds good to you at the moment, how fast you want that order to be filled. So then you now control 100 shares at 74 cents. The expiration date is 43 days out. This is way cheaper than buying 100 shares outright. So for $74, you own 100 shares or control of 100 shares for the next 43 days. And then if you were to buy these 100 shares outright, it would cost you $1,383. You could buy 1,800 or have control over 1,800 shares for that same price if you were to pay $74 for an options contract for one share of these. So you're getting it at a massive discount. You don't own the shares at this price, but you own control of the shares. You can make decisions based on this. So the downside of this is you're paying 74 cents per share or $74 for the whole contract of 100 shares. And this kind of puts you down a little bit in the beginning, right? Because American Airlines is $13.83. And we're going to also buy it at $14, which means the price has to be $14.74 per share before we even start to make money. Now, is this helpful? Yeah, if it goes to $15, we're confident in that. We're leveraging the power of these options to control more shares with less upfront investment. And if the stock moves in your favor, you can make a lot of money. I'm a very visual person, and so if we jump into Robinhood here, I don't trade on Robinhood necessarily, but I think they have an excellent chart that shows you how, when price moves, how you will profit and how you will make money. So currently, American Airlines is $13.81. If the price stays below $14 here, we're just we're just losing money, right? We're not going to do very well. However, as price begins to move up and it touches on that $14.75 zone, then now we're making money. And if American Airlines continues up, we will continue to make more money. And essentially, it's infinite, right? It could continue to go up and we'll make money. But if it doesn't, then obviously we get shut down, right? So in theory, it's unlimited, but the odds of American Airlines going to $20 or $50 or $100 is kind of unlikely. Now, let's jump into selling options. And this is kind of my bread and butter. This is the sweet spot. Selling options can kind of be likened to selling insurance to other market participants. When you sell a call option, you're selling the rights for someone else to buy the stock at a specified price by a certain date. So, a practical example, say you own 100 shares of American Airlines that you bought at $13. You're comfortable selling these American Airline shares at $14 because that's going to give you $100 in profit just in stock appreciation. But when you're selling this call option, you can collect some premium as well. So, we just showed buying call options. Well, there has to be a seller of the options, and that's the other side of this trade. So it looks like a similar trade ticket, except this time we're selling instead of buying. And so again, American Airlines has shifted down just a little here to $13.82. And we want to sell the $14 call for December 20th, which is 43 days out. And we're going to get paid $74 for selling these shares. So say we sell this call, we get $74 in premium. And how will this play out? Well, if the stock price never hits $14, we're going to keep the $74 premium, earning a 5.6% return on our initial $1,300 investment, because, right, we paid $1,300 for 100 shares of American Airlines. So that $74 premium is ours to keep if it doesn't hit $14, and we don't have to do anything with our shares. If the stock exceeds $14, remember we entered a contract to sell our shares at that $14 price. So we could miss out on further price appreciation. Anything beyond $14, we just don't get to keep. However, we would have made $100 in that price movement, $100 in stock appreciation from $13 to $14, plus the $74 premium. This gives us a 13.3% return on our $1,300 investment, which really is pretty impressive considering the S&P 500 on an annual basis returns around 11%. We could make that in a month. Pretty exciting stuff. Now, there's also a bonus here. If you're holding the company, this whatever stock or shares of a company that pays a dividend, and you happen to be holding it over its ex-dividend date during this time period, you'll also be able to collect that dividend because you're a stockholder and you're making money on selling the call. So by selling the call, you're earning extra income on shares that you already own. Now, you don't want to lose them necessarily, but you won't if the stock price doesn't hit that strike price. And if it does, you can always roll it up and adjust that price. We can cover that in a separate video. Or we can let them be called away. We can sell them for a profit. We made our premium. We made hopefully our appreciation in this price. And kind of go from there. So let's jump into Robinhood again, take a look at how this would play out for us if we were selling an American Airlines call. Now the price here is $13.83. Currently, we're going to collect, say, $73 in premium here. And as long as that price stays below that $14 strike price, we're just making money. We're making gravy. Our shares won't be taken away from us, and we get to keep our premium. However, if it continues up, our break even is going to be at $14.73. Now, if the price continues to go up, we're not technically not losing money, but we are missing out on that extra appreciation, which is a downside. But we made pretty good money along the way, and we can roll these options and adjust things accordingly. So kind of recapping things, option selling versus option buying. According to the Chicago Board Options Exchange, or the CBOE, about 10% of option contracts are exercised. Another 55 to 60% are closed out before expiration, and approximately 30 to 35% expire worthless. So, with this, that kind of tells us that selling options tends to be the more profitable or consistent pathway. It can give us routine returns because the sellers of the options, only 10% of these are being exercised. So buyers are only exercising their rights on these 10% of the time. Now, of course, the 55 to 60% are closed out before expiration. That could be buyers capitalizing on their profits. 30 to 35% of them expire worthless, which kind of gives the sellers a little bit of an advantage here. Now, option sellers, consistency. Statistically, you will win more often as an option seller and generate a more consistent income. However, your profits are often capped. So you're going to collect a premium, you're going to make some money towards that strike price, but there's a limit on how much you can earn from each trade. So option selling, more consistent, maybe better returns routinely. That said, option buyers, statistically, you are going to lose more as an option buyer. However, your profit potential is essentially uncapped in theory, right? Your profits generally are larger. You can make more when you do select the strike price and the option or the stock moves in your favor. So, selling versus buying, which one is for you? That's up to debate. Which one fits your trading style more? Personally, I like selling. I like to collect dividends on shares of stocks that I own while I collect a premium on selling calls for them. I also like that price appreciation, movement up towards that strike price that I've selected to make myself money and collecting the premium along the way. Kind of just adding extra money to the bag as we move along in our journey. In today's video, we reviewed call options, buying and selling calls, and a little bit of why you may or may not do it and which one is maybe potentially right for you. Obviously, there's a bunch of different situations and circumstances, and at times both of them can be right for you. You may favor one or the other. However, when you're in trading and you see an opportunity, the other one might work out for you. So, thank you for joining me today here on this episode of Financing Freedom in our Options 101 series, where we learned about buying and selling call options. In our next video, we'll touch on buying and selling put options, the definitions of those, and why we might want to trade them as well. So, please like and subscribe for future content, and thank you for joining me.